back to our continuing discussion on economic reforms in India since 1991. In the last session, you have learned about the reforms in industrial sector. Number one, the doing away with licensing, which gives more freedom to Indian industries, and number two, to give more areas of industrial operations to private sector, which was earlier run by public sectors or government-owned industries. And in financial sector, you've also learned about the reforms where since 1991, private banks were allowed to operate. And these private banks can be Indian or of foreign ownership. It doesn't matter anymore. And also we've learned about the opening up of economy by inviting the foreign institutional investors to come and invest in India. Those were the two things we've learned in the first session. Today, what we've learned, continuing with our reforms, we'll talk about reforms in the tax system. We call it fiscal policy. And we'll learn about the reforms in foreign exchange and trade and investment. So on four fronts, we'll look at the reforms in today's session. So you will learn about fiscal policies, the taxation reforms 1991, GST, very important initiative taken up by the government of India. We'll learn about the devaluation of a rupee or any currency. We'll learn about, like I've said, foreign exchange reforms. And there you will come to learn about these concepts of QRs we have learned earlier, tariffs, and lastly we'll talk about the need to reform trade and investment. Okay, so we'll start with taxation reform. Tax reforms. So we have learned earlier that in order to kickstart development activity, we need to spend. The government, in order to be able to spend, it has to earn. And from where it earns these revenues? We've learned it's from taxation and other sources like profit from PSUs and so on and so forth. But today we'll talk about tax, because tax is the very important and one of the largest contributor to our government's revenue. Okay, and when we talk about that policy of taxation means earning revenue, and from there to spend on expenditure, that those policies are under the fiscal policy. So when we say what is fiscal policy or what are fiscal policies, it's the government taxation and expenditure policies on how to earn, how to spend. So those are fiscal policies. And in these fiscal policies, that's why it does not look only from the earning side, but from the expenditure side as well. So at the moment, let's concentrate on the earning side through taxation. And we've learned that there are two types of taxes. One is direct and the other is indirect tax. And direct tax are those tax which we say the impact and the incidence falls on the same person. An example of the direct tax is income tax. You earn, you have to pay. No one can pay it for you. You have to pay it because it's a contribution from you. So when we pay a tax, it's not only our responsibility to pay. It's not it from what we earn, but you understand it's also imposed on us. So there is a way that when it is too much of an imposition, we feel it as a burden. So it shouldn't be like that. The government should see a policy, should have a policy that impose on us, that we feel it as a responsibility to give back to society, not as a burden. So that's why over the course of time, these direct taxes, like taxes on individual income tax, or tax on the corporation, the companies, called corporation tax, all these have been on a lower rates. What I mean to say is, earlier these taxes were high, and when they were high, it's difficult for people to pay, for companies to pay. That's why they try to avoid paying tax. They try to avoid by hiding their earnings. Okay, all these are kind of um, evasion. We can say they are not legal. The government wants us to pay, but since it's too high, it's a burden, so we evade the tax. That's called tax evasion. Tax evasion. So, seeing that, okay, tax is high, people try to hide away from paying a tax. So the government should see that if they lower down the tax, people will come forward and there will be more earning. There will be more tax base, we say, when the rate is low. So it is important that the rate should be lowered down so that the government will earn more because people are complying to paying tax when the rate is low. So that is one of the reforms that the government tries to um, implement till now because it knows by lowering the price, the tax, more will comply to paying it, and it will be the revenue to the government. Same is the case with corporation tax. Corporation tax to companies are also being reduced over the period of time. That is from the direct tax. Okay, the direct tax that has to be paid directly by the earners, by those who earn the money. Okay, so what we see from here is that there has been a reform. There has been a change from high tax to low tax, and by doing so, the government earns more because there's more payment, more compliance by these taxpayers. Okay, now let's look at another important reforms in taxation, which is on indirect tax. Indirect tax are those taxes which are imposed on especially goods and services, not on individual income like the direct tax. But here you can see that when you buy goods, you pay the tax. Okay, but there are other rules, many other example of indirect tax. But let's say that you understand it from the point of view of paying when buying a product. Okay, so every product produced or every product brought from outside, imported from outside, has to be included in a tax. Okay, and so there is what you call sales tax, there is excise duties, custom duties. All these are indirect tax on goods produced or goods bringing from outside. And so over the years, the government has also tried to bring about a change in these tax structure. And we find here in 1991, in order to facilitate the an establishment of a common national market for goods and commodities. That's why they felt the need that something should be done on indirect tax. There are too many taxes in the market. That's why they want to bring about a common platform to be able to charge to people who are dealing with these goods. Okay, so what do they do in these kind of reforms for this taxation? Number one is to bring about simplification. And by simplification means that they make the system simple so that the people understand how much they have to pay. They know the procedure to calculate how much they pay, how much they have to pay, where to pay, when is the last date, how to fill the forms. All these kind of things are important because when it is simple, it will encourage better compliance. And what should be used to be the case that tax system in India is used to be so complex and cumbersome for the common man to understand. So they try to simplify that. That is the reform number one. Number two is that rates on these goods have also been substantially lowered. So these are the two important things that we talk about um, reforms in indirect tax. And another important historic moment in India in 2017 um, is the goods and services tax, which was actually passed 2016 It's the unified indirect tax system, replacing many taxation system which you have sales tax from one state to another state. Okay, because one goods passing from one state to another state has to pay tax all the time whenever it crosses the border. Now that has changed. There is only one tax for the whole country. Okay, but these the rates of tax are different. It can be 0%, 10, 12, 18, 28%. Some goods falls on these categories of percentage, but compared to earlier system, this has been very systematic, and that's why this is a very um, important legislation passed in 2006 and a very important act that can bring about a change in the taxation of indirect taxation in India. So by passing this law, expected to generate additional revenue for the government and reduce taxation and create what's importantly one nation, one tax, one market. So that's about the tax reform. Okay, so you learn about fiscal policy, you learn about two types of taxes, you learn about the decrease in tax rate for better compliance in the direct tax, and secondly in indirect tax you learn about the simplification of procedures and the lower of rates and the important legislation of GST. That's the reform in taxation, fiscal policy. Now let's go to foreign exchange reforms, how we deal about foreign trade. The first important reform in external sector was made in foreign exchange market. Okay, so when we deal with the rest of the world, we sell goods, we buy goods. That's the foreign trade. We earn foreign exchange. There is a market for foreign exchange to exchange your domestic currency with currency of the rest of the world. So in 1991, what kind of reform did we undertake? It was to first resolve the balance of payment crisis. Remember, the crisis 1991 was the reason why we had economic reforms, and the main reason is um, the crisis in the balance of payment where the foreign exchange was too low. Not that. That's why we need to. That's the immediate um, solution that we need to find. So we have to bring about rectify this problem of a crisis in the BOP. So the first reform here in foreign exchange market was the devaluation of Indian rupee against foreign currency. Devaluation, devalue. What do we mean by devaluation? What is devaluation of a currency? Devaluation of a currency is the government decision to deliberately weaken the value of its currency. Like in the case of India, to weaken, to lower down the value of rupee against other countries' currencies, against the dollar, against the pound, against the yen, and so on and so forth. Why do we need to devalue? We need to devalue to increase the inflow of foreign exchange. When we lower down the value of a rupee, it means our goods produced from India becomes cheaper. When it becomes cheaper, we can export, we can sell, and we can sell, we can get foreign exchange. People pay, will pay to what they buy from us. We can sell more because it's cheaper, it's competitive now in the foreign market, in the international market. That's why we start earning foreign exchange. Okay, so that's the first thing we did to um, rectify the problem of BOP crisis. Devalue the currency. Number two is that from now onwards, the government has tried to free the determination of rupee value in the foreign exchange market from the government control. Earlier, how much to exchange for a dollar, for a pound, is controlled by the government. $1 is equal to how much? It's controlled by the government. But from now onwards, market determine exchange rates. It depends on the demand and the supply of foreign exchange. How much do we demand dollar? How much do we demand rupee? That will determine how much is $1 equal to a rupee. Not anymore determined by the government. So by doing so, that means there will be a free adjustment of a rupee over foreign currency. Why would you want to do this? It's to bring about a flexible kind of foreign exchange system. Okay, to strengthen our foreign exchange earnings. So that's the reform we did in foreign trade, external sector, devaluation of currency, and market determined rates of the foreign exchange, not anymore by the government. And lastly, we need to also reform our trade and investment. Remember, the first reform that we talk about is the reform of industries. And if we reform industries, of course, more goods will be produced. But where will we send those goods? We need to trade. So if we don't reform the trade at the same time, all those goods that we produce becomes redundant, not it? And we also want to develop industries. We open up industries, give more in of private sector. We also invite foreign investment to be able to develop industries. So if we now reform industries, if we don't reform investment, then also it will not be bear fruits. It's not it. So at the same time, in order to support industry, we need to change the structure in the system in trade and also the policy in investment. So that's why we need the last reforms, trade and investment policy reform. Trade first, trade and investment. Why do we need? We need because by changing all those redundant rules before, policies before, it will lead to an increase in international competitiveness. You bring about openness, you bring about competition. Our industries will no longer be protected, but they will have to face the future. They will have to face the reality. They have to compete, not it. And by liberating, by of reform in the investment policy, will be able to attract foreign investment, get more funds, and at the same time will be able to bring technology and develop our economy. We need all these. We need the fund from outside. We need the know-how, the technology. But if we have restrictive policies, how can we bring those in? So that's why we need to all change that in order to bring about more strength to our industries. So the aim was also to promote efficiency of local industries, adoption of modern technologies. Local industries can bring in technologies. So it's not that they can compete, they can become efficient in due course of time. Also, what are the initiative taken in these two policies of trade and investment? Earlier, India was protected. We know that there's quantitative restrictions. What are quantitative restrictions? Quantitative restrictions are prohibitions or restrictions applied or maintained by the government, by the country, on importation of exportation of goods. When we buy, when we sell, there's no freedom. There's always restriction. We have to follow the policy, the rules. And all these, instead of helping the economy, they are detrimental to our growth. So these are frequently enacted to protect the price of domestically produced goods. When we do so, since our industries were infants, we have to protect them. But if you keep on protecting, they will not grow. Not it. So that's why we need to do away with these quantitative restrictions of imposition on the goods we buy, we sell out with the rest of the world. So the example of quantitative restriction like quotas, licensing, how much quantity can we bring in from outside, all these are done away with. That's the reforms. These were there before that we need to change. We need to change. We need to replace. We need to remove, in fact, quantitative restrictions. And also there is tariff. Tariffs on the, why do we need to impose tariffs? Tariffs are different from QRs. Tariffs are taxes imposed on imported goods. When importers brought those goods from outside, they know the price, but they have to pay a tax on those products. So that's why they are called tariffs. That's why they make the price of those imported goods costlier. When they become costlier, people find it difficult to buy. That's why they have to buy Indian goods. It's like protecting Indian companies, Indian industries. But too long imposition of tariffs, like we've learned, they in fact detrimental, because they will not be able to bring in the competition. When you don't have competition, you're not efficient. So that's why the government realized this. If too much of restriction, like quantitative restriction on goods that we bring in, high tariffs that they have to pay, all these they reduce efficiency, all these they slow the growth of manufacture. So what do we need to do? Number one is dismantling of QRs on imports and export. Remove altogether this QR. Let's go that side. Quantitative restrictions in imports of manufactured consumer goods, the goods that we use at home, manufactured by industries, and agricultural products, products produced by agriculture. On these two areas, fully removed from 2001 April. So that's the reform in trade policy, trade and investment policy. We remove the QRs on manufactured consumer goods and agricultural products. Now you can freely trade those with the rest of the world. That's the number one reforms in this section. Number two, like we've learned, the reform is to reduce the tariff rates. Okay, the tariff rates, the rates that are imposed on the goods we bring from outside. And number two, also the imports duties that exporters have to pay to be able to sell outside have also been removed. And why we removed? To increase the competitive position of Indian goods in the international markets. So when you have export duties, they raise the price, you can't compete. When you have import duties, they raise the price, we don't buy, we protect industries, but we bring in inefficiency. So both import duties like tariffs and export duties have been either removed or lowered down. Okay, so that's the number two um, reforms. And lastly, in trade and investment policy, removal of licensing procedures for imports. We need not apply for a license to buy goods, which was there earlier. All these are quantitative restriction to protect Indian industries. Now they remove all those protection. They want them to come in and compete with Indian goods. And import licensing, if you continue, was abolished, except in case of goods that are hazardous and environmentally sensitive industries. Those are chemical in nature. Those are threatening the health or the environment. Only those that needs to be carefully studied before given go at bringing those goods. Only those are still under import licensing. Except these, all others you can bring in, no more license required. So these are what you've learned. So many, is not it? Right from the top, reforms on taxation, direct tax and direct tax, GST, reforms on foreign exchange, devaluation, market linked foreign exchange rate, trade investment policy, doing away with all those restrictions, licensing, and why do we do so? We've learned now to bring about efficiency, to bring about competitiveness, to grow our own industries, to strengthen our own industries so that they can become world-class industries. Not it. So too much protection is not good in the long term. It in fact um, bringing weakness. It weakens our system of um, industrial structure. So what you've learned? You learn about what are fiscal policies. I hope you've learned. What about the taxation policies on direct and indirect taxes? You can write a short note on GST, Goods and Services Tax 2006. You know about devaluation of currency, and you can find out the difference with depreciation of currency and devaluation of currency. There is a difference, although they both lower down the currency, the value of currency, but there is a difference. You need to find out devaluation and depreciation. We have learned here about devaluation. Then we've learned about foreign exchange reforms, especially what we talk about devaluation itself. You've learned about QRs done away with. You've learned about tariffs imposed now have been lowered down, and you've learned about trade policies and why they imposed, what's the aim, all those. So I hope, even though it covers 3, 4 areas of or sectors, but they are important policy reforms that help India what is today. Okay.